These are in listen-only mode.
Good evening, everyone, and welcome to the October issue of Digging into the BI. This is where your volunteers from the Better Investing chapters of Maryland and the DC Regional get together and look at the latest issue of Better Investing. And tonight we're going to be looking at Ignacio Eagle Mines, Church and Dwight, Evercore Partners, and Ford Motor Company. So let's get going and let's go to our next slide, please. Our standard disclaimer here, we're doing this for educational purposes. We are not recommending any stocks to buy or sell. We believe, as Better Investing does, that you should be able to conduct your own review and analysis of companies. If we happen to mention a particular site or locations that we find information, it is not an endorsement of that. We may or may not own the stocks that are involved. We are recording this for future use, and it will be up on our YouTube channel, hopefully sometime later on tonight. Let's go to our next slide, please. So again, I think looking through the list, most of you are regulars, but just in case you're not, and for those people that are on YouTube, who Better Investing is, as you'll see at the top of every one of these slides, you have the URL for Better Investing. We're an investment education organization. You can see that down below. That's a hyperlink to understanding who we are. And then the second one is our methodology of looking at things, which is a long-term fundamental investor. And all of the people that are speaking here tonight are volunteers. None of us are in the financial services industry or do anything in that particular area. But we just do this because we enjoy it. Next slide. So again, we are an investment education involving learn by doing. The two people in that photograph on the right is George Nicholson, who sort of got things started, and on the left is Tom O'Hara, who ran the organization for, I don't know, 30, 40, 50 years and the like, but they believe it, and we still do that today, that this is the way to invest on your own. Next slide. So here is that YouTube location that I told you about. Up on the top, that's a hyperlink. So you can click on that and it will take, if you download the slides, and we'll show you how to do that in just a moment, you can be able to go straight to that YouTube page and be able to look at it. If you're not already, please subscribe. Also like it, because that's how the YouTube algorithm works. We would like to, it helps other people find us. Particularly those folks that are interested in the long-term fundamental investing approach. So please do that for us. And you can share that. You don't have to be a member to see those. Next one here is that, again, no, we can go on, stay on slide 6, Cheryl. So yeah, we, again, most of you are regulars, but in case you have some trouble and you're here in the audience, we want to be able to, let's go to the navigation, slide 6. So let's show them how to be able to move around from slide to slide. So up, we're moving around a little bit. So let's go back to 6. We're on 7. See, you can tell we're all volunteers. We're trying our best to be able to get things going here. Over on the right in the green with that black, darkened, blackish grayish thing, that's called your control panel. And you can move that out and back through the arrow up there in the top. If you want to move that so that it's not in your way, you can grab it where the green circles are with your mouse and move it to another part of your screen. You're going to be muted during the presentation. When we get to question time, we will unmute you. You can always raise your hand by hitting the hand icon, but go ahead and type in your questions along the way. We'll have some of us taking a look at that to keep in touch. And let's go to our next slide. So again, most of you are regulars, but if you do need help with GoToWebinar and the like, there's a quick video on how to get started. If you're having trouble with the help button, you can sit there and go where that red arrow is up to the globe and the help stuff that should be able to help you. There's also the audio settings. Most of us are listening to this. I know I am, and being part of it on my laptop. That will take you to computer audio, but if you're using your phone, you can use it as a phone call. And again, like we have here, is don't forget to download those handouts. You'll have 5 of them there, 4 completed SSGs, as well as this slide deck that we have here. We go through things fast, but at least you'll be able to have this to take a look at, and you'll be able to see the recording later. Next slide. So to be able to help you see things a little bit better, up on the top where the 1 is, you can be able to zoom in, and that sort of corresponds with where it says zoom there. That's right next to that 87 is a drop-down window, and you can make that full size so you can see more. And if we happen to go through something pretty fast, you can just easily hit where the number 2 is and do the screenshot, and you can be able to save that image so that you can go back, and when you're trying to remind yourself of what you wanted to talk about, you can do that. Next slide. So why are we doing this webinar? Well, other than the fact that we like looking at stocks, it's a way to be able to promote better investing in their resources. There's a free 90-day trial for anyone. So you can share these slide decks with people that aren't in the better investing community and want to know more about it, prospective people that may be joining your club. Go ahead and do this, and you can be able to show them basically how we do this. We do this designed to be able to help beginners. In fact, Cheryl and I just finished teaching the SSG class for the DC chapter, and I know the Maryland chapter is doing theirs towards the end of this month. But this is a great way to be able to see how other people do it. Great way, even if you're not a beginner, to be able to see best practices. It's a way to be able to work between the 2 chapters. We have 3 model clubs and the Visit a Club program, and just to be really part of the a better investing community in the Mid-Atlantic, whether you're in Virginia, DC, or Maryland. Next slide. So in just over an hour, we're going to do 4 SSGs. That's a lot. We understand that. We really sort of rush through them, but we're going to do 2 that come from the latest magazine where you have to be a member to get it, but that's the Stock to Study and the Undervalued feature. Tonight, that's going to be Church and Dwight and Ford, respectively. After that, the other 2 presentations will be something that was found through the Better Investing website on a magazine, either or personal experience. But generally, we want to be able to find stuff that you can find on the BI site and not have to use additional resources. Even though a lot of us do have additional resources, we're trying to maximize your use of your Better Investing membership. Next slide. So to be able to see those announcements, this particular one for Church and Dwight and Ford was announced all the way back on July 26th. But you can be able to find this by going to the main page, and it's under Home About Us and News Releases. And again, as Cheryl's sort of showing you right there, that hyperlink, you can click on this if you have the download, and it will take you exactly there. So you can already see that they have this stuff for next month. TJ Maxx and Boeing will be the 2 of the stocks we're looking at. We'll have a complete list at the end of these slides. Next slide. So to not miss any of these future announcements, if you're a member, we want you to go in and you can go under where it's My Account. And from there, you can go over to where the green circle is in the lower left-hand side. That's your email and product subscription. And that will pull out the green box over on the far right. And that's where you can sort of select what you're going to do in terms of what things you want. If you don't want any of the partner news or member announcements and promotions, you can opt out of it. But here is the local chapter news if you want to find out what we're doing either in the DC regional or the Maryland chapter, depending on where you're located, do that. But before you finish that and hit the Save Changes at the bottom, go up to where the yellow highlight is, where it's the BI Weekly newsletter, and you can be able to get news from the DC from the headquarters, and we'll show you with our next slide what they do. So this is a member exclusive, and they highlight on national education stuff that's coming out of different events that we have. They're called Ticker Talk and Stock Up. There's also first cut reports and stock ideas that are there. It comes out around the close of business on Thursday. And if you signed up for this on that previous page and you're not getting it, check your spam filter. But here's some of the things that are coming up that really look kind of interesting to us. There's a couple webinars that are on the 13th and the 27th. But we also, I like the stock ideas. You can see some screens that have been done to sort of help out with quality and dividend paying companies, and that may interest you. So go ahead and click on those things to see them. And those are all connected on hyperlinks. So if you get it in your email, you can click on them and it'll take you directly to that spot if you're signed into your Better Investing account. Next slide. So you can also connect with those of us in the Facebook, either at the DC regional or the Maryland chapter. We'll try to put up notices about this. I sometimes get a little bit behind and don't always get them up on the DC regional, but go there. Those are live links that you can take there. You don't have to be a BI member, but it's certainly, again, another way to be able to connect or show people that are perhaps interested in your club what we do, and they can sort of see what kind of approach we have for investing. Next slide. So, Cheryl, why don't you tell us about what's going on with this new thing that's coming on this month? You have to unmute yourself.
Sure do. Thank you. Don't know where my brain is. We are very excited at the chapter about educational series that we're trying to get off the ground, especially this first class. We ran into Craig Bramer when Kevin and I were out at the Better Investing National Conference and talked to him about setting up this educational series, and he said he would be glad to help. This is one of the education classes that he taught at the national conference. So if you tune in, you will actually see part of that. It's on the 17th of October from 7 p.m. to 8:15 p.m. and online for GoToMeeting. The cost is $10 unless you are a chapter volunteer for either Maryland or Virginia or DC. And so otherwise, very reasonable $10, and come and listen to what is sure to be a very interesting class.
Thank you. And let's go to our next slide. And Brian, tell us about, you got the next couple of slides telling us what's going on in the Maryland chapter.
Good evening. At the Maryland chapter on Saturday, October 22nd, from 9 a.m. to 2:30 at the College of Southern Maryland on the La Plata campus. That's the information there. What we do is we analyze 3 companies in the same industry, and at the end of that, we do a stock comparison guide in order to see which one of those might be the better choice. So that's all included in the class. That's all for this one, Kevin.
All right, let's go to our next slide.
Okay, the Maryland Model Investment Club is undergoing reconstruction. The original one there has ceased operations, and so beginning next year, we will try and turn it into, or take the Model Investment Club, and our emphasis will be to make it a virtual money model club. So it will be a little bit easier for people to join the club, and we'll use virtual money to buy and sell stocks. And if they need to leave, it's be easy for them to leave and to take the information and start clubs or of their own. And so that will be starting after the first of the year, not exactly known yet, but go to the chapter website and we'll keep you informed.
Thank you.
Thank you.
Let's go to our next slide. Okay, so this is one of our 2 model clubs in the DC regional. This is the Montgomery County, Maryland Model Investment Club. We have 8 partners. There's a picture of us at our summer social. We do like to get together twice a year in person. All the rest of the time, while we are supposed to be meeting at the Rockville Library, since the pandemic, we've been on GoToMeeting, and I don't know if we're ever going to get off of that. Our education is going to be part of the Adding Judgment series that was done at um, from the BI headquarters. We're just focusing on the dividend payout ratio. And then our stock study will be a Tractor Supply. And if you want to reach us, there's our email address. And that link up there, that link, if you come there on October 19th, will get you to us, and visitors are welcome. Next slide.
All right, I think I've got this one. I am a member of the Model Investment Club of Northern Virginia, otherwise known as McNova. We started out in 2008, currently have 12 partners. We meet on the second Tuesday of the month, so the next meeting will be on October the 11th, also from 7 to 9 p.m. We are in the same situation. We were previously meeting at Tyson's Pimmet, but now we are virtual. And here is the link right here. It's a GoToMeeting, so you don't have to register previously. And here's a phone number in case you need to check in via your phone. Our education is going to be the new audit function in the online tools, and the stock study will be in mode. And there is our point of contact if you wish to contact us.
Okay. And Janet, why don't you tell us about your club? Well, one of your two clubs.
Hey, Kevin. Virginia Commonwealth Investors Club has 12 members. We have 23 companies in our portfolio. We started in 1996. We meet at 6:30 by Zoom every month. We will be looking at some of the My Club reports, and our stock study will be Ford Motor Company.
Very good. Thank you. All right, let's go to our next slide. Cheryl, tell us about this.
I will. We have a listing here, both one for the Maryland chapter and one for the DC chapter. These are clubs that are interested in adding members. And so if you want to contact them, there is a point of contact with an email on those lists to see about joining their meeting, probably beginning as a visitor and then whether you want to join or not. And so those are some of the options that are open to people. I know lots of times we get questions as to, where's a local club that's looking for member. And so we have these lists on our website under both of those two chapters. The other type of visit club that I want to talk to you about is having a chapter director come to visit your club, help you out with things that you're struggling with in your club, whether it's how looking for new ideas or what's new on the website, or how you go about selling. These are things that a chapter director could come and visit you and help out, and it doesn't cost you anything. We can go to you either in person or virtually, depending on how far away you are from where we are. And it makes a nice camaraderie, and I know I've met many wonderful people from different clubs that way, visiting their clubs, and it's been rewarding for both of us.
Okay. All right. Last month, I asked everyone how many folks wait for the BI magazine to come through their post office. I'll ask you again. You can just sort of put it in the question box to get some practice. Over on the left is you can get it on an app on your phone or on your tablet or something like that, or you can look at it on your e-magazine. Last month when I asked this, we had a lot of confirmed Luddites out there that you guys just wait for the paper. I wanted to see how many of you actually use either the app or the e-magazine. There were a couple of you that said, I use both e-magazine and paper, but go ahead and humor me and see if we've gotten any better at that. But those are available to you as well. Let's go to our next slide. So again, if you need to know how to get onto the BI magazine for mobile devices, if you look at the green arrow over on the far left-hand side, that will show you how to be able to get there if you're signed in under the Learning Center. And it's a different password than what you have for getting into BI, but they'll walk you through it and it's pretty easy. Also, the red arrow gives you analyst reports and other resources. That's the additional information that's mentioned for the two featured stocks every month. So the stock to study and undervalued feature. And So you can be able to go there, and some of the additional information is there, but it's only online. So go ahead and take a look at that if one of those stocks interests you. Let's go to our next slide. So we try to feature at least one article from the BI magazine, since this is called Digging into the BI. I found this really interesting. This is George Nicholson, one of the, again, sort of our intellectual founding father. This is something back from the Home Office that was written in 1975, and it's 12 lessons about inflation investing. And since we have some of our highest inflation in 40 years, it may be relevant to take a look at it. There were some really interesting points I saw in there that were worthwhile. Please take a look at that. And also, one of the other articles I saw, it was a toss-up. Craig Bramer, who will be speaking for us later on this month, he has an article in there in this latest magazine as well. So go ahead and take a look at this. Let's go to our next slide. So again, the final thing in the BI magazine is page 51 is all the investor events stuff that's available. And again, so there in the blue, that's the Maryland chapter and DC regional chapter, the thing for the case of growing dividends with Craig Bramer. And then there's one, some of them are free and you can just, you don't have to go physically. And we're showing one that's from the South Florida chapter. They just started on this Saturday, a 5-part series on cash flow and a deep dive on stuff. Cheryl and I couldn't attend because we were actually teaching the local SSG class. But hey, anyway, take a look at those things. Sign up for them. It's a great way to learn and a great way to be part of our community. With that, let's go to our next slide and let's start talking stocks. All right, so we're going to do 2 stocks in core. Ignacio, if I'm saying that right, Eagle Mines from Brian, and then Church and Dwight. We have listed Anna, but we have a last-minute pinch hitter, and that's going to be Jonathan Hunn is going to help us out because Anna was tied up with work. So let's go to the next slide, and Brian, it's all yours, and tell us all about Ignacio Eagle Mines.
Okay, good evening. I'm Brian Koenig, a volunteer director in the Maryland chapter. My company tonight is Agnico Eagle Mines Limited, symbol AEM. Company was chosen to do a first cut after the company merged with Kirkland Lake. Next slide. Since the company was founded in 1957, Agnico Eagle Mines Limited has consistently delivered shareholder value. Dividends have been declared every year since 1983. It's grown into a senior Canadian gold mining company with precious metals operations in Canada, Australia, Finland, Mexico. And currently, in addition to those countries, the company has high quality exploration and development efforts in the United States and Colombia. AEM is part of choice, or is a partner of choice within the mining industry and is recognized globally for its ESG practices. Next slide. And this gives you an idea where some of their operations are. Over in the bottom right is 16 is in Australia, Finland is up in the top center, and the other ones are in the United States and Canada and Mexico. Next slide. With the merger, AEM now has a mineral reserve base of 44.6 million ounces of gold and an extensive pipeline of development and exploration projects. Next slide. It's divided into 3 business sections. The northern one, southern, which is down in Mexico, and then the exploration, which is Canada, Colombia, and the other countries that it has. Next slide. Some analysts have a fundamental outlook for gold as neutral over the time. CFRA mentions that gold is losing its market to cryptocurrencies. Some skepticism of whether cryptos will be a good gold substitute. However, it's clear that the demand for crypto is limiting gold right now. It seems to me like the last time we had inflation that the gold went up, and this time over the period it's gone down, what, 2% from about 2,000 down to around $1,600 an ounce. So I don't know, maybe cryptos are having some effect on that. Next slide. Now I'm analyze the Agnico Eagle using Core SSG. Before I do that though, the AEM has 6 production assets, and with that, they have excess of 300 ounces of gold, and for 2022 to 2024, it's expected to be about 3.3 million ounces of gold each year. Next slide. Okay, now we'll analyze the Agnico using the Core SSG. It's a medium-sized company in the basic materials gold industry. Next. And tonight my presentation will not go directly through each tab and step in the core, but I'll combine some of those steps. However, I will take a short deviation here because in Core SSG, you don't get a picture of the SSG until the end. So what I've done here is I've taken a little bit of a peek ahead, and what you'll see here is this is from SSG, but I wanted you to see that before we start this, to answer the 2 questions that we always get. Are they up, straight, and parallel? Look to be so. And does management have an idea of what's going on? I think that's true of them. So bear with me while I took a step ahead to SSG or to the SSG Plus or to the SSG itself. Next slide. Okay, here we're going to evaluate management, and what we're looking for is in the last 5 years consistency. And here, other than 2018, it's been consistently and going up. 2017 was in 15, but the other ones are in the mid-20s. Next slide. And for return on equity, similar. We want it to be consistent and also with the peers. Again, 2018 was an outlier, so that was taken out. Management return on equity of 8.4, which is very good. Next slide. Another indicator of management skill is how debt is employed. If we look at step 3, total debt, and step 4, percent debt to capital together, it gives us a little better understanding of how the company is managing debt. Here in step 3, one can see that Agnico has been an excellent at reducing debt, especially in the last 2 quarters. And in step 4, the most pronounced drop is a result of paying down debt with possibly increasing capital. So you have to look at step 4. If they could have paid off a lot of debt, or they could have paid off debt and gotten more capital. So the debt to capital went way down. Both of those are excellent indicators of management. Next slide. So before I get to tab 3, step 1, where we forecast sales, I went to the research menu and got member sentiment. And out of the last 90 days, there were 112 SSGs done. And the average for sales was 17.3, and earnings per share was 11.5. So that gives me a start as I'm going through my numbers of where I might others think that the company is located. Next slide. So with the first 5 years removed, so I can see what are you doing for me in the last 5 years. We can see that the historic trend is 15.3%. It looks like it's going to increase from that, so I'll be a little bit of conservative and have my forecast be 15%. And that will result in a projected sales of just about 7.7 billion. Next slide. Again, for forecast earnings, take away the first 5 years. This one is a little bit different. Is from 2017 to 2019, it increased. From 19 to 21, there was a very small increase. In the first 2 quarters of 2022 are down. However, with all of the reading that I've done, even though the historic growth was 21%, I think that 15% would be representative. and with a 15% growth rate, that would result in a 5-year earnings per share of $4.47. Next slide. So now what we want to do is we want to forecast a high price. If we look at the historic PEs, I deleted 2017 and 2018. In the last 3 years, I gave an average of about 36.5. So that's good. Cheryl, could you go to the next one? Now for the low price, for the low PE, you're there at the top. You'll see that again with 27 and 2018 detracted or redacted, that the last 3 come out to 18.5. Now, Cheryl, I'd like to ask you to go back to 42. Okay, if you take the average of the high and the low that we just did, what we come out with is an average forecast PE of 27.5. That isn't explained anywhere else, but I wanted to let you know why I got the 27.5. When I multiply that by the 4.47 from the front side connector, that comes out with a high price, forecast high price of $122.80. And that's with a closing price of on 9/30 of 42.23. Next question. Next slide. Okay. Now for the forecast low price, we look at the low 5-year average low PE of 18.5 and the last 4 quarters of trailing 12 months of earnings per share. The low earning forecast is $1.93. That comes out to 35.70. However, if you get the low price too close to the current price, it makes the upside downside very high, which even taking 80% of the current price with a $33.80 also gives us a pretty high price, but we'll deal that when we get there. So I chose $33.80 as a low price. Next slide. So here are the indications over on the left from 122.80 at the top down to the division between the hold and sell of $100.50, between buy and hold of $56 and $33.80 is the low price. We come out with the buy range of $33.80 to $56, and so $42.23 is in the buy range. Next slide. Okay, here's where we do the upside downside, and we took the 122.80 down to the current price of 42.2. Then we took the current price 42.2 minus the low price of 33.80, and which gives us a 9.6 to 1 upside downside ratio. I decided not to go back and manipulate the SSG. I thought maybe that would be an exercise for the people watching tonight to do that. There are ways to get that down more in the 4 or 5 range. That wasn't part of what we're doing here. I just wanted to get this set up, but I'm going to do that to get that more down in the 4 and 5 range. So next slide. So to determine the 5-year potential, what we do is we have a payout in if you look at 2021, 63.1%, that would mean that out of every dollar of earnings, they're paying out 63 cents. But so we'll take an average over the last 5 years. It said that they've paid out about 44 cents, 43.75. So using that average payout, the compound total return is the price appreciation would be 23.8%. The current yield is the yield would be 1.6%, and gives an annual rate of return of 25.4, and the current yield is 3.8. And the next slide. So in conclusion, Agnico Eagle Mines Limited, it's a medium-sized growth company. It's well managed. It's currently on sale as our just about every stock on the exchanges right now. It's trading well below its 5-year average. Those you can see the close and the upside downside ratios to the 25.4% return with the market near a bottom, and that's my question, who knows what it is. It could be a good medium-sized basic materials purchase candidate if it improves your portfolio. That's all I have. Thank you.
Thank you, Brian. Okay, let's go to our next stock, and this is the stock to study for this month. And Anna was supposed to lead us, but we ran into, she couldn't make it, and we had some other technical things. So at the last minute, Jonathan Hun is pinch hitting, and he's a great pinch hitter. So go ahead, Jonathan.
Thank you, Kevin. So we will be covering Church and Dwight. Next slide. So Church and Dwight is actually the stock to study for the current edition of the Better Investing magazine. And you can see at the bottom if you can find this on page 20. Next slide. So Church and Dwight is in the household and personal products industry, the consumer defensive sector. It is a medium-sized company, and it is the leading producer of baking soda in the world. It was actually started in 1847, so it's been around for over 175 years. The company also currently sells many different products. It's really branching out into laundry products. You can see cat litter, there's oral care, deodorant products. Most of what they have been doing is growing by acquisitions, and we'll talk about that next. Next slide. They have 15 of their products that they consider their power brands, and this represents more than 85% of their sales and profits from these 15 products, and that would include Batiste. Batiste, you can see overlying the one. Batiste is a dry shampoo. Spin Brush, also overlying the one, is their electronic toothbrush products. Overlying the 5, you can see Vitafusion. Little Critters are their chewable vitamins for kids. Flawless is a product that they're using to remove hair. It's an electronic hair removal product. They recently acquired Hero, and I'll talk about that in a minute, and Zicam, and then you can see some of the other products. So again, these are their 15 power brands that represent more than 85% of their sales and profits. Next slide. It's a global company. 76% of their revenues are coming from the domestic market, 18% internationally, and then they have a specialty products division. Now this includes research-based animal and food products and also cleaners. They have developed, for example, a baking soda or sodium bicarbonate abrasive blasting product, and this is what they used to clean the Statue of Liberty several years ago too. So that's part of their specialty products division. Next slide. Their international division is growing quite nicely, almost doubling over the last 7 or 8 years. Next slide. Their growth primarily is through acquisitions, and you can see over the last about 18 years, they have acquired quite a few companies, and their revenues have increased from 1.5 billion to 5.4 billion. Their latest acquisition, you can see in 2022, is this Hero. Next slide. Hero is a new product that they've added to their healthcare division, and it is the #1 patch brand in acne care. And it also represents the #2 acne care product overall in the United States. Next slide. Now, one of the things that they'll do, they will acquire different companies, but they will continue to innovate those products, those particular products. And you can see they've entered the laundry care business and developed are continuing to develop products for their laundry care. And you can see that on the left side where they have this baby detergent that they're currently marketing. So many of these new acquisitions, they are continuing to develop new products from those acquisitions. Next slide. Now, I'm going to talk about some of the risk and uncertainties, and these primarily come from Morningstar. So this would represent, I would say, one individual's perspective on the risk and uncertainty. But some of the concerns that they have are Church & Dwight has no moat. In other words, it has no competitive advantage. They're also concerned about Church & Dwight entering niche markets where they don't believe it has many of the same expertise. And they used examples of the water flossers and the electronic hair removal product that they have. They also felt that Zicam, for example, they paid far too much to acquire Zicam. And this also increases their skepticism in the durability of Church & Dwight's ability to grow through acquisitions. Next slide. They also have concerns about the size of the company. It's relatively small when you compare it with its main competitors. And one of the main competitors would be Procter & Gamble. They don't think Church & Dwight's overall brand strength is very high at all. In fact, they consider it low, and that's part of the reason why they've given it a no moat category or designation. They have are considering Church & Dwight's ability to compete for shelf life or shelf space very difficult too. And you can see that 24% of their revenues come from Walmart. So if Walmart decides to make some changes to their inventory, this could potentially affect Church & Dwight. And they also have less resources spent on R&D, research and development, and advertising and marketing. Next slide. This graph really says quite a bit. Considering they're growing by acquisition, their sales have been consistently growing. Their earnings have also followed suit consistently over the last 10 years. Their price bars have been consistently reaching new highs every year. So despite some of the concerns that Morningstar or maybe other analysts may have regarding the acquisition strategies, they're doing something right, because this is relatively up, straight, and parallel for their sales and earnings, and this looks really good. Next slide. Their sales, if you look at Church & Dwight's sales over the last 10 years, they have a growth rate of 6.4%. Now, granted, this is a medium-sized company. We expect medium-sized companies to grow between 7 and 12%. So this doesn't meet that objective. However, when you compare it with the industry average and the peer group average of minus 3.1 and 1.9%, it's significantly better. Next slide.
5 minutes.
Similarly for earnings, earnings are growing for the last 10 years at 12%, and this is much better than the industry average and the peer group average. Next slide. And looking at management, profit margins, almost 19%, significantly better than the peer group average of 7.8%, and the industry average is a little bit better than the industry average of 16.5%. And similarly, at the table below, return on equities, 26.15%, and is much better than the industry average, and almost comparable to what the peer group average is performing. Next slide. Their debt is relatively high, it's above 33%. However, it's lower than the industry and peer group averages. Next slide. So this is my table of the analysts' projections. And if you look at the top row, sales percent and the earnings percent. Now, all the way on the left, you can see that the 5-year average historical for sales growth has been 8.4%, and earnings has been growing at about 10.5%. All the way on the right side, tabulating all of the analysts' sales and earnings growth, I'm coming up with an average of 4% for sales and 6.3% for earnings, and that's what I'm using for my sales and earnings forecast. And those are comparable to the analysts' sales dollar figures for the next 5 years and the earnings dollar figures for the next 5 years. A little over $6 billion for sales and $4, a little over $4 for earnings. So these are reasonable projections. Next slide. The average high PE that I'm using is 27. This is slightly below the last 5-year average of 29. And I used 27 because I thought there was a very slight trending decrease or downward trend for the PE. So I settled on 27. You multiply that by the high earnings, and we're getting a high price of $113.80. And if you look at the analysts' projections or forecast for the high price in my table above, I'm getting an average of $99.33, and that is a range. The analysts are ranging between $81 and as high as $121. So I'm probably closer to the high range in the high price category. Next slide. And the low price, I settled on $54.70, and this was less than, slightly less than the 80% lower. It's less than the 20% below the closing price of $71.40. Next slide. So I'm getting, with my analysis, a Church and Dwight in the hold zone with a 2.5 to 1 upside downside ratio. And at the very bottom, you can see the table is showing a annual total return of about 11%. Next slide. So Church and Dwight is a medium-sized company. I said it was moderately growing based on its earnings growth, which is averaging about 12% per year over the last 10 years. It's very well managed, and it's slightly undervalued currently. And I think it would be a good candidate for a watch list at this point. It's actually in the hold zone, not in the buy zone. So I think it would be a good candidate for the watch list. Thank you.
Again, thanks for stepping up there, Jonathan. We appreciate it. Okay, now we're going to go. We're now going to go to SSG Plus, and I'm going to start off with talking about Evercore. So let's go to the next slide. And so here we are. Evercore I found by doing a custom screen in Better Investing. I found it kind of interesting because I was trying to find something that wasn't like in a BI first cut and on the heat map and hadn't really been discussed, but I could find a good quality company off of the custom screen. So let's go through this and we'll see how we came up with it. Next slide, please. So here's how I did my custom screen, and you'll see this throughout my presentation is I have a lot of hyperlinks. So if we go through things pretty fast, you can be able to take a look. But up on top, if you want to know how to do custom screens, that's a Ticker Talker stock up that we had about a year or so ago. So there's basically 8,245 entries in the Better Investing universe. I said, let me look at just U.S. exchange ones. So it got me down to 5,600. I said, I like medium-sized companies. So I did that. We got to 1,400. You can see at each step how many were still left. R squared is for earnings R squared. It's basically just how straight the line is. And if you need to know more about it, click on the hyperlink when you download this. And then we wanted to have some of those management metrics of pre-tax profit and return on equity. I then added the Morningstar health grade and profitability. And again, there's some hyperlinks if you want to understand that those are good metrics for them. And then I wanted a PEG ratio, which means it was probably on sale based on what its earnings is to its PE. I got 9 results. And I looked at Evercore, and one of its competitors is right there, Tier Moelis. But some of the other stocks that are in my clubs, like Medifast and UFPI Industries, are there as well. So it was kind of an interesting setup. So let's go to our next slide and talk a little bit about Evercore. So I like stocks that are in the mid-sized company. It's in the S&P mid-cap. I like them because they've sort of gone through the growing pains of smaller companies, but they're not such huge behemoths that It's hard to be able to find them at a good price. They're in capital markets, and what it really means is that they're in investment banking. They do mergers and acquisitions and stuff. So their competitors are things like Morgan Stanley and Goldman Sachs, which are large firms, but they're really in what's called the boutique firms, and that would be Lazard, Moelis Company, and Houlihan Lokey. And if you need to know that about boutique, there's a link on it, but it's basically sort of small niche investment banking stuff. They have 98% in investment banking, but they're really sort of subdivided into other stuff. On the downside, like Jonathan was mentioning with his stock, this has a narrow moat, not no moat, and it's a sort of standard allocation. And for those people that use Manifest, it has a core score of 105, so it's not necessarily what would be considered a core holding, but a little bit on the friskier side. So let's go to our next slide. And let's understand a little bit about what goes on in investment banking. When you and I buy stocks from the stock market, we're really in the secondary market. And so when companies are privately held and they want to be able to go public, they look for investment banking to help sort of manage that financing, which is basically underwriting, debt, and placement. That's the primary market. So that's where they sort of operate. If you want to understand more, there's a hyperlink on the right-hand side about investment banking. It's only about 5 minutes, really easy. And so what they do is they make their money off of fees. They get a percentage of it. So it can be from raising funds via financing, which is underwriting, helping to set the market, advising on spinoffs and IPOs, debt restructurings, and lending money and managing money. So that's what they work on. Next slide. So one of the things I like to do is when CFRA has an analyst covering it called a quality ranking, page 2 is basically a summary of their SEC filings. And I can read on this one page without having to read 3 or 4 or 5 pages of stuff that's on several different SEC things, reports. So it's pretty good look at where they are. I just sort of, if we come down to the bottom with financial trends, 78% of their revenues are derived in the US. So they are kind of local, and that's sort of consistent with sort of boutique firms. Next slide. So I also like to look at the CFRA industry surveys, and you can find this through our library. And this is kind of dense, and it focuses more on the really large ones. But here's some of my first signs that it's maybe not such a good one to be into, because again, if you see all the yellow highlights on the right-hand side, the Federal Reserve is raising interest rates. That doesn't help them. There seem to be headwinds in terms of what's going on because companies are not going to start doing IPOs in down markets. They're only going to do them when things are going pretty well. So if we're in a recession for maybe another 6 months or 9 months, that can hurt them depending on wherever it is. It can cut out into their underwriting, and it's when things start getting better, they'll start to do better. So it has sort of a cyclical nature to it, and you have to sort of keep that in mind. And so having a company that's good financial health and manages stuff well will be critical with this. Next slide. Here comes from 2 slides from their investor presentation. You can see, again, they're working a lot more on growing their underwriting capabilities. They have a goal of trying to get up into the top 10 of underwriting. To take a look at those things, they're currently around 17 overall. But here's one of the things that's kind of important to remind, the yellow highlight over on the right-hand side. One of the things in their business model, and this happens for a lot of boutiques, is they really grew out of, really flourished right after the financial crisis in 2008 because there were a lot of shenanigans by the larger houses. And so this gives a chance for them to be a little bit more smaller and nimble. And they really have fewer partners, and they have a lot more of their junior partners or junior members, staffers working with senior partners and sort of really cultivating those employees that work underneath them to sort of help them is really one of their best assets, is to get young people that are sort of helping them out. So that's sort of a key thing with all of these boutique firms. Not that it doesn't happen with larger ones, but keep that in mind. Next slide. If you want to learn more, here's some hyperlinks and the like. I think they're pretty straightforward. Motley Fool had this as one of the investment banking stocks that they felt the evaluation was too cheap to ignore. But there's some really good videos and stuff if you want to take a look, and none of them are super long. One is a blog piece as well, but take a look at those things. Next slide.
5 minutes, Kevin.
Damn, I got to move faster. All right, here's Morningstar's report. They have it as a 5-star rating, which means it's really undervalued. They're comparing them to Morgan Stanley and Goldman Sachs when I think they're more along with the Lazard challengers. And again, as you look over on the right-hand side, their economic moats, they really don't have one, and it's that intangibles is basically their employees. Next slide. If we look at the visual analysis, it looks really, really good. However, if we see the highlighted in yellow, that quarterly figure is awful. Why? Well, because things have really sort of stopped in that kind of market. And if you see the red circle in there, it's trading near its 52-week low. This potentially could be a value trap. If you don't know what that is, click on download and look at that link. But it's basically, it looks like it's on sale and it really isn't. Next slide. If we look at the quarterly data, again, the last 4 quarters and all of these key metrics are really bad. So if you were to walk away from it, it wouldn't be okay. Another way of saying a value trap is it could be a falling knife. In our SSG class this week, we talked about not crossing a barbed wire fence. This would be crossing the barbed wire fence. Next slide. But I'm going to show you if you're a little bit more advanced, if you start looking at these things, maybe you can see a way out of this. So if I highlight, you see the red circles in the right-hand side, I can turn on and see the detailed estimates on that one. And I can find that by going into data detailed estimates. That they only have at the far end in 2024, that's just one analyst looking at it. So, but you can see a real downturn in there, and that's not looking good. Next slide. So if we look at this a third way, is you can go old school, what they used to do with pen and paper. They had peaks and troughs, and you can be able to sort of see, if I just sort of marked the peaks, which would be the green dots in the earnings, and if I looked at the yellow ones, those would be the troughs, you can see those growth lines are really still really quite good. And again, this had an R squared of 70, which isn't too bad. And this works if you have a solid company with good health grade, which it does, but you have to measure everything from that trend line, which I've highlighted in sort of orange. Let's go to the next slide. So the fourth way is that if we sit there and we start this from the trend line and we sort of look at those troughs, what I can do is if I'm starting from that trend line, I can sort of see maybe a potential U-shaped recovery. So starting from that lower number, I can sit there and say, look, it can still grow at about 12%, which is significantly lower than the trough was showing, but it may work. And with a preferred procedure, I get that sort of not too far off, and that would be sort of those sort of horseshoes over on the graph are basically sort of showing you that this is what will happen in this. And they've consistently done these things, a lot of investment banking firms. So let's go to our next slide. So here are some of their competitors. You can take a look at this later. They're all pretty solid. They're all above the industry average. There's nothing standing out. Next slide. If we look at the high and low PEs, they're coming down. I've sort of measured them like that. The newest thing is the blue highlights where you have the trailing 12 months at 9.8 and 4.7. And that seems to be sort of a trend. And if we look at the graph, they're pretty consistent down there for the last 4 or 5 years. The graph down in the bottom center. Next slide.
2 minutes, Kevin.
Thank you. All right, and so then if we look at the forecasting high PEs, I'm going with a high PE of 10, and that gives me a forecasted high price of 229. I think those are really reasonable when you consider sort of the history, and I don't think I'm being that crazy on it. The downside is that we've got a 2-year period here that may be really, really rough, and you really have to think of this as a 3 to 5 year time horizon if you're going to invest in it. Next slide. So we'll look at the low ones. There's several options in here, and I don't think you can use a low PE for something like this. That goes for really a company that has those up, straight, and parallel lines. 80% is too optimistic. I'd like to always be below the 52-week low. That's too optimistic. And the recent market low at $33 is the price from the global pandemic, which may be too conservative, and it doesn't really function with the dividend option, which would generally be for companies that have a payout ratio over 40%, and I have this at 25%. So I just sort of eyeballed it and said, let me go 35% below it, and that's how I set my price. Next slide. So our potential gains, we get a 5-to-1 upside downside ratio. Looks pretty good with those caveats, and a really nice potential return at 179.6. Next slide. So we look at our 5-year potential. I think it can really sort of sustain at that 25% payout ratio, which gives it a yield of 3.6. It has a total return of 25% and a par at about 18. Those are both pretty high, but I think considering the potential here, that's not unreasonable. We've been really conservative in terms of my forecasted sales and earnings on the front side, and I think we understand its limitations. Next slide. Here are some ratios. There's sort of if you need to understand these things, there's a calculation, but they're really, these really are, the relative value and projected relative value are really, really low. So they could be a value trap or a falling knife. Big caveat. Next slide. Here's the audit. This is the new feature. I know they're going to be talking about it in Cheryl's Club. The conclusion is, yeah, these sales and earnings are going down, kind of are slowing down. You better be careful, and that relative value may make it too good to be true. Final slide. My conclusion, explosive growth, well managed. It's either on sale or it's a falling knife. And I really think it could be a candidate for purchase, but I think it may be too risky right now. It may be better to put it on your watch list and just sort of be patient and sort of understand the industry a little bit more. That's my conclusion. Thank you. Janet, you're up.
Muted. Unmuted.
Are you there, Janet? I can't hear you. Cheryl, are we having a problem with Janet there? Or is it just me?
No, I can't hear her. I tried to mute and unmute her, but it's not showing up, and I don't see anything from her in the chat.
She logged off, and I think she just logged
You hear
back
me
on.
now?
Yep.
Yes.
Very good. Thank
I
you.
went out and came back in. I don't know what happened. I'm so sorry.
That's okay.
In addition to what you see on this slide, there's also a very comprehensive VI First Cut study by John Dufresne in June 2022. Next slide. You will find the article on Ford in the October 2022 magazine on page 25. And the editorial and advisory committee members addressed the consistently dropping share price of Ford stock this year. Consumer lack of confidence in the economy, of course, was one factor, as well as concern over how James Farley, the new CEO, would work out during the restructuring of Ford. Next slide. When I first brought up Ford in the SSG Plus, I was puzzled why it was even selected. Not only that, it's been featured 3 times in BI as recently as 2020. And then it was reviewed and it hadn't even met the expected 20% gain for an undervalued featured stock. But the price is at the bottom of this year's range. And the more research I did, the more I've really come to appreciate this company. Next slide. Almost a century and a quarter after Henry Ford put his first car on the market, the company now has moved into 2 divisions. Under the Ford name, Ford Blue, they are continuing the internal combustion powered models, and Model E for the electric and connected vehicles. It also offers Ford Motor Credit Company. It has leasing, it has insurance that it offers, and it offers Ford Pro management software to service small businesses that have fleets. Ford was second to General Motors in 2021, but their goal is to be the largest EV producer. It has about 12.5% market share in the United States, about 6.5% share in Europe, and about 2.4% share in China, including unconsolidated affiliates per BI. The United States sales of its Ford and Lincoln brands provided about 64% of last year's total revenue. Next slide. In March, Ford said it was investing $50 billion for 2022 to 26 electric vehicles to move away from the hybrid to the battery powered. It's already broken ground in Tennessee, a place called Blue Oval City, for a new plant to build electric trucks and advanced batteries. It has about 183,000 employees, but they're going to be cutting a lot of those employees as their e-products require fewer and different parts to build, as well as, of course, different skills. The challenges for Ford and all auto manufacturers are the wait for semiconductors, there's some parts, and dealing with inflationary prices and labor shortages. As well, of course, as in the United States, they have to work with the United Auto Workers for the companies here. The releases for the vehicles that are sitting waiting for these may have to wait until 4th quarter, and these challenges might even go into 2023. Next slide. September 22, Ford put out a press release and they announced their new leadership to strengthen product creation and transform global supply chain management. Their Ford President Jim Farley said, as we enter an intense period of execution for Ford Model E and our $50 billion investment in breakthrough electric and digital vehicles, Doug Field, Lisa Drake, and Chuck Gray are taking on larger roles and building out very capable teams. They're developing and scaling the next generation of electric and software-defined vehicles, and it requires a different focus and a mix of talent from their accomplished Ford team and many exciting new colleagues that are joining their company, which include 4 leaders with Silicon Valley credentials. This leadership team, supporting outstanding talent already at Ford, is setting the direction on technology platforms for Ford's next generation products. Next slide. I wanted to see which electric cars are the most popular, and I went to Kelly's Blue Book on YouTube. I, by the way, have a Toyota Camry hybrid, so this has been fascinating me anyway. Well, the most popular ones on there, Tesla is the most popular, these 2 models here. It's just in recent years, though, begun to post earnings, and YouTube reviews on the Ford Mustang Mach-E are stellar, and they compare favorably with Tesla. Then there's the Chevy Bolt, the VW, and the Nissan, which were also popular. Next slide. Trucks have traditionally held, of course, the most profit for dealers and are actually the most value for buyers. The Ford 150 Lightning E truck has been exceedingly popular, though. There's also a startup vehicle manufacturer in which they invested and lost some money. That's the Rivian, that's been popular. And then, of course, the GMC Hummer EV pickup. Next slide. Value Line ranked Ferrari, Tesla, Ford, and GM as the most timely shares to purchase right now. Toyota had the best safety ranking, but a less promising future for investors. Ford is expected to grow as it's moving away from their less profitable internal combustion sedans to their electric vehicles. And they expect an annual production run rate of over 600,000 EVs by the end of next year. That's per Value Line in August 12, 2022. Next slide. Per Morningstar, the competitors are Honda Motor, Nissan Motor, and Renault. Next slide. I settled on Honda, GM, and VW as the competitors. Next slide. I took a fake or virtual $1,000 to invest in each of these. I did a PERT in our BI portfolio with my SSGs. Ford came out to be the winner there. Next slide. Now I have to admit, this SSG was the most challenging I have done since I first started learning how to do them in 1996 when we were doing them by hand. I must have done 6 different ones before finally just biting the bullet and committing to this one. Based on my research, I decided to go with 3.5% sales growth in line with Value Line. I'll say Toolkit had much lower than that. Because earnings history is so volatile before COVID and because of the uncertainty right now in the economic and world conditions, I gave 8% as my earnings. Again, higher than Toolkit did. I believe there's much promise in Ford's future, but it is embarking on new technology. They were slow to hop on this bandwagon, but they did so with great fervor and commitment. Next slide. Their pre-tax profit has improved over pre-COVID years, though it's short of the 15%. Their 2021 shows great earnings on equity, and they brought the average to 15.9% despite COVID. Debt, though high, was brought down last year. In section 3, I put the PEs from 2019 as outliers, as well as the 6,000% payout. Next slide. Usually I feel comfortable paying as much as 24 times earnings for many stocks, but as the high price for Ford this year was $25.87 and Value Line projected $30, Morningstar projected $37.20 with a fair market value of 24, I didn't dare project my PE that high. Both Value Line and Morningstar saw around $25 to just short of 26 as the average price in 5 years. So I went with 8 as my high PE. That gave $29.70 as a high expected price with $3.71 high earnings. Since prices are continuing to fall right now or be so volatile, I wanted to be even more pessimistic. And so I chose $7.50 as my projected low price, which is close to the average low price of the last 5 years. Next slide. The current price of $11.20, which was from last Friday, appeared to be a strong buy, and it warranted the undervalued designation by BI. Now at the bottom, when you saw on the other one, the 165.1% in appreciation of price in 4E. That was really, I think that's more related to the emotional reactions of the market right now. The total return of 25.7 and the reward to risk ratio of 5.0 to 1 indicate that this might be a fire sale opportunity. As I said, this was a very challenging stock study to do, but I did learn a great deal from it. Next slide. So it's a large size, slow growth company, but it's actively restructuring. This is a turnaround play. They are well managed with new leadership positions in place, so we need to watch it. They are undervalued. They are a buy up to $13 per my SSG with a 5.0 to 1 reward risk ratio and a 25.7% total return. So it could be a candidate to purchase while also undervalued. I think you might need patience and fortitude during this especially coming year because of the volatility and the uncertain economy.
Well, thank you, Janet. Well, folks, we went through a lot of stocks real quick. Let's do a recap. We'll always ask all our presenters where this sort of fits on the life cycle. So again, there are 4 stocks that we did. Let's go to the next slide and we'll tell you a little bit about why we talk about the life cycle. It comes from T. Rowe Price, and it believes that most corporations pass through a life cycle of growth, maturity, and decadence. And let's sort of see this. This shows up in our handout, the digital handout. If we go to the next slide, that's a graphical representation. Down below is a hyperlink to the digital handbook that you can get. But let's start. Brian, tell us why you put that location for Ignacio Eagle Mines.
Well, it kind of has to do with after the merger with Kirtland Lake. I think that they've got a lot of growth to do. However, I put them up near the top of that part because since gold is a commodity and with the cryptocurrencies, I'm not sure that you're going to have the rapid growth in gold like has been seen in the past before the cryptocurrency showed up. So that's why I kind of picked there. We'll come back to this in about 5 years and see how good a guesser I was.
Very good. Jonathan, tell us why you have that location for Church and Dwight.
Church and Dwight is a medium-sized company, and their earnings, for a 175-year-old company, their earnings are still growing quite rapidly, on average about 10%. And again, we expect for a medium-sized company to grow sales and earnings between 7 and 12%. So their earnings are growing quite nicely. Much of their growth, again, has to do with acquisitions, and they've been acquiring companies since the 1860s or so. So if they continue this growth pattern, they seem to be very successful doing what they're doing. And if they continue to acquire companies, they continue to innovate, I think they are have quite a long growth runway ahead of them. So I put that star right between the explosive growth and the mature growth at this point.
Okay, thank you. And I put Evercore more in the explosive growth, not at the beginning, but sort of towards the center. You know, it's grown really, really well. Again, this is just one you have to be a little bit patient with because it does have sort of a cyclical nature to it. And that's the reason why you've got to have a well-managed company to do it. But investment banking, there's always going to be a need for it to be able to help finance and do that. And their strength is really in their employees. So I think that there's a lot that's still good there. Janet, tell us why you put that for Ford.
Well, I put Ford at the top of the mature growth as the industry is changing. It is a pretty old company. I think Ford figured out they're either going to be left in the dust or they're going to continue to reinvent and focus toward the new technology and begin to grow aggressively with a great promise. Their CEO and their highly skilled team are really committed to them becoming a leader in the EV autos. So I'm really eager to see how well they actually progress in that endeavor.
Okay, thank you. So we've done all the talking. Let's go to our next slide, and I think it's time for you all to vote. It's not on which one to buy, but which one has intrigued you enough for a greater study. And after that, then we'll open up for questions. We just got Ed has joined us in the back room here. So do you want to sort of handle the questions as they come on in? If you can look at them, that would be great. If you can help us out there, Ed.
Radio.
Thank you. Okay, let's look at how we're doing on this poll. All right. We're at about 50%. Let's see if we can get ourselves up. We usually like to get up into the 70s or 80%. So a couple of you are kind of quiet over there. You can only vote once. This isn't Chicago, my hometown. A little bit more. Can we get another vote? One more. I think that may be it. We might as well have to close it off. There we go. And share the results and let people see what we got. There you go, folks. You guys really like Church and Dwight. So good for us. I tried with Evercore, but no one wanted it, or they didn't want it as much. Okay, it's now time for our questions, and go ahead and take us through some of those that are out there, Ed.
Yeah. Basically, one that went unanswered is actually associated with your presentation, and it is from Lola. She asks, is EVR like a startup company in the sense that it is looking for angel type investors or venture capitalists?
They're neither of those. They're not a startup company. They've been around since 1995 and have been publicly traded since 2006. They're investment banking. They're a boutique investment banking firm, and they help take companies that may have started with angel investing that want to be able to get on out into the publicly traded market. So they're sort of like a smaller, more nimbler Goldman Sachs or Morgan Stanley would be the best way of answering that. I hope that did it.
Yeah, I would also add that it would be somewhat, and in your slide, you kind of hinted at this. It's a little bit of a conflict of interest to actually be operating like looking for angel type investors and venture capitalists. It kind of, so that goes contrary to that model as far as conflict of interest rising.
Mm-hmm.
Okay, the other question, and Brian answered this, but for everyone's benefit, in case they didn't see that, there's a question from Fred Beckman regarding what is R squared. In the answer, Brian included a reference to Investopedia. It is a statistical measure. In short, it's just how straight your line is. So I'll give you an example. If the R squared is equal to 1, it's a perfectly straight line, which with SSGs, we really like those. If it's a really low number, then those data points are all over the place, and it is about as crooked as you can get. Brian, there was a question that you also answered earlier regarding your presentation. Would you mind maybe going right to that slide and addressing it, if you could pull that up real quickly?
It's Cheryl, if you go to slide 35, it's the eliminating the outliers.
Got the menu thing in my way here. All right. Oh, 35. Here we go.
Okay.
So Brian, would you be able to?
That's probably not the, Cheryl, could you give me control for a second?
I can do that. Hold on one second. Let me go back to And Brian, you're up on top here. There we go. And make
While they're
you,
doing that, let's cover another question. There was a question regarding do electric vehicles depend on the same electricity households depend on, i.e. the electric grid? This question was also from Lola. I'll read Brian's response and then I'll let other people chime in. From what I understand, the EVs use electricity from the grid, but the charger changes it to currents that the EV battery can use to charge. And and Brian has gathered this from YouTube videos that he's viewed when he's researched this topic. So anybody else have anything else to chime in on?
Brian, you are the presenter right now, and all we're seeing is a beautiful sunset on a flat top.
Oh, man. I'm trying to find where my people is, where I am, so I can.
Well, let me know if you want me to take it back.
Yeah.
Oh,
No,
there we
that-
go.
So I can. There you go.
That was the SSG. That was the SSG that went on for a split second. Now we're back to the flat top. There you go.
All right. I see that I got to move some other things out of it. Okay. The reason I did that is if you look at, if I leave the other dates in there for the earnings per share, you can see that the first few years, quite a bit of variation there. And if you leave those in there, you'll see that the trend line comes out with a 53% growth rate. So that was one of the reasons that I took out the years. And as I started taking them out, I figure that usually the last 5 years are the ones that are going to do it. When I did that, it came out with a more reasonable, I'll call it more reasonable 21%, because if I switch over to SSG Plus and we look at here with the
estimated.
With the data estimates from Value Line, you can see that they start to match a lot better with by taking those data values out. So that was the reason. And if we look at earnings per share, it's the same as the sales for those reasons.
And just on that point, we actually have 3 stocks, Ford, AEM, and my Evercore, that all had some kind of cyclical nature to them. So, having to adjust it. Whereas Church and Dwight, being consumer defensive, really had much more straighter lines than any of the other 3. It's the nature of the stocks we were looking at. Any other questions, Ed?
No. I think that covers them all.
Okay, and I'm going to take
Carol,
back control here. All righty, and what, anybody remember what stock number page number we were on? 80 something?
Go to 113.
Okay. Yes, thank you.
And if you, yeah. So anyway, with that, we did our votes. There's our way to be able to reach all of us in either the Maryland chapter, the DC chapter, or is digging into the BI. There's a picture of some of us that were at Bink and the like. So come and join us with that. Can you put this in the full screen view under view?
Oh, sorry about that.
It's okay. And if you want to be able to receive more information about this, we do have, you don't have to be in the DC chapter. Next slide. And, but you can sign up for that. And that way you'll be on our email list that Carol does such a great job of getting it out. We don't bombard you, but we communicate with you. And that will take care of you regardless of whether you're in our chapter or not. Anyway, next slide. Jonathan, you want to tell them a little this in the next slide, talking about how to volunteer and all that fun stuff?
Sure. Better investing in general is made up of hundreds, if not thousands, of volunteers. So this is a wonderful way to stay connected with like-minded individuals. So we always encourage everyone, anyone and everyone, to try to participate in the Better Investing organization as a volunteer, and volunteering your time to help teach other people. The best way to learn is to teach, and so the more that we educate one another, the stronger as an organization and as individuals we will be and we can become. So we encourage everyone to try to volunteer with your local chapters and help out as much as possible and stay connected. And it's a great social organization, and come join us. Thanks.
Thank you. All right, let's move on. We're just about done, folks. We'll show you some of the things coming up. I put these are relatively new, but again, if you download the handouts, this will take you to some of the links on Manifest. You normally have to have a subscription, but the stuff I have up there are public dashboards, so you can see how we've done with these stocks just from the date of when we did the presentation. So there's 4 different dashboards are broken out by the year in which we did it. So this is our 24th presentation. And we have the ones that were winners by the audience, and then those, all the ones that are in there. Go to our next slide. And again, you can just, if you download this, you'll be able to click on that link right there and be able to see it. Or you can just sign in, if you do have that, under the Manifest Investing, and go to Publish Dashboards, and just type in, if you can't remember, just type in digging into, hit submit over on the right-hand side, and you'll see all 4 of them. And next year we'll have 6 of them. So take a look and see how we've done. We'll do another review in January, probably. Next slide. So there's, again, links to be able to get to all of them. Pretty straightforward. And finally, another slide. Thanks for being here. Again, that hyperlink up on top is to the YouTube page. Please join up, get the subscription. It helps us in terms of reaching people. Share it with your friends or people that are looking to get involved in your investment club, or you want to be able to show them the benefits of it. Let's go to one more slide and we'll be able to see what we're going to look at next month, since we already know.
And Kevin, we do have 2 questions that came in. I just wanted to let you know.
Go ahead. Then go ahead. Let's take those right now.
Okay, one from Carl Lawrence, who asks, is my understanding correct that the SSG doesn't work so well for cyclical stocks? If this is so, what alternative tool is there?
It can work for a cyclical. I just showed you in my presentation how you can do it. For beginners, we sort of think of up, straight, and parallel as sort of the mantra we talk about, but it can clearly, as I showed you with peaks and troughs, you can be able to look at those high and low points. And again, this is just a way to organize your thoughts to do things. So I would say, yes, it can be used, because this form has been around since the early 50s, and we have people have been very successful purchasing cyclical companies. So I would say, yes, it can be used for that. You just have to be a little bit more discerning. It's maybe not as easy to see as it would be with a classic up, straight, and parallel. Any other questions?
And Kevin, I would also add that with the low price selection, there's also a category specifically designed for cyclical stocks. So when you're trying to make a decision on low price, the SSG has a section specifically designed to take into consideration cyclical stocks. So yes, I would agree with what you're saying.
Yeah, it's at recent severe market low. And again, in my handouts, you'll be able to see I went through all the different options that you can see under plus. So we're sort of we're seeing your inbox, Cheryl, and it looks like you got a few emails
Yeah,
that you have
all
to.
it ended with was the thank you. It didn't have
Oh,
the
okay.
telling
Well,
what's next month.
I can tell everyone just from that. So next month, our stock to study is TJ Maxx, and the person who's making that presentation, I see her in the audience. Cynthia will be doing that. She's done a great job. I don't know why it didn't come through. And then our undervalued feature is the Boeing company. Rudy Watson will be doing that one. And then Cheryl, you're doing, which one are you doing?
I am doing.
Alta Beauty. I put you on the
Yes,
spot.
thank you.
And,
Ulta Beauty.
and then our final one, I'm drawing a blank real quick right now, is Bank of America. We got a new presenter, someone from the Washington Metro Investment Club. Melvin's going to be doing
Yes.
that one. So come back and see us. That will be
So
on the
before
first
we
Monday.
wrap things up,
Go ahead.
we did have that second additional question.
Go right ahead.
Does the Better Investing Club ever measure valuation by taking multiples of revenue, comma, earnings, comma, and free cash flows?
Jonathan or Brian, you want to take this one?
I don't have an answer.
I can. How about you?
I'm not. Yeah, I'm not.
There is in the
No.
SSG under plus, not in core, you can look at free cash flow. There is a way to take a look at it there. In plus, you can also measure some of the debt. So yes, there are features there. And a lot of us, once you get more experienced with this, you can look at stuff outside of the SSG to sort of help you with that. But the bottom line is, yes, you can do those things. It works.
Those are more of qualitative measures rather than core quantitative numbers that are plugged into the more traditional SSG formulas. Is that a fair way to characterize that?
Say that again.
That in looking at things like free cash flow, they help you to qualitatively assess what you're looking at that stock, but those numbers don't directly feed into the traditional SSG formulas that help form the final judgment.
That is correct. That is correct. So
So
yeah,
here is the graph, and I just lit up the free cash flow was the purple line there. And you go into data and annual data, and here's your cash flow right there, year by year. Is that what you were going to show, Kevin?
yeah, those are things. Again, with something like the gold mining company, it may be a little bit harder to see, but it clearly is worthwhile. It may show up better on my Evercore. I just sort of ran out of slides, time and slides to be able to put that in. I don't know if you just have the you just have the PDF of mine, but if you just type
Right.
in, if
So
you just do the
I'm doing
SSG,
5 below. How's that?
Five Below would be a really good example of that.
All righty. So here's the annual data for that. And here's your cash flow. And then
And if you show it
here.
graphically, it may be easier to see, I think, of people, particularly that are visual learners. And you can take off all that, take away all the sales and pre-tax profits so they can just see what's going on with free cash flow. Again, this is a semi-log graph, which really just helps measure the rate of change rather than the absolute value. And again, you can see in a retail company, they got really, really hit hard because guess what? The pandemic is 2021 in this fiscal year, and they must have had something that happened in 2019. I think they may have sort of made some acquisitions or did something that's really, really down. If you put up the shares outstanding, I usually will put that with free cash flow, and you get a pretty good idea of maybe what happened there.
It also, you have to look up here in the box. It says that their quarter ending is 7/22.
Yeah.
So they are not one of those companies that ends at the end of the year for their fiscal
That's
year.
their second quarter. So yeah, they usually will end probably in January. And if I put up put up total debt, that may sort of help us figure that out as well. All right, so they did acquire some debt. My guess is that they were doing that and took free cash flow. They didn't add more shares. So they basically were probably trying to be able to change something in terms of maybe their position or what have you. And that would take some investigation to take a look at it. It's again, the numbers are great, but I think one of the things that's equally important is to do the research behind it to sort of figure out what's going on. And again, I sort of did that with Evercore to sort of explain why some of those things were happening. So hopefully that answers your question.
Yeah,
Any
I can
others?
bring up EVR if you want.
No. Let's see. Are there any other questions? We're pretty much at the bewitching hour, and I want to respect everyone's time.
Yeah. We're at 8:40 and there are no more.
Okay. Anyway, thank you all for being here. Come and join us next month on, I think it's November, is it 7th? Whatever it is, the first Monday in November, and we'll be doing those 4 stocks. Thank you all for being here. Good night, all.
Good night.